On Friday morning, at 10 a.m. New York time, two things happen in the same minute. One of them is a speech. The other one is a spreadsheet. Almost nobody has the second one in their diary. Together, they can undo whatever nvidia says on Wednesday night. By the end of this, you will know what those two things are, why every major index fell last week in a week of record earnings, and the one auction result that explains all of it. Nothing here is advice, and it is not a view on any share price. It is a reading of last week's own documents. Because something changed last week about how prices get set. The best chip earnings of the year landed on Wednesday. Revenue up 40%. Record margins. A record forecast on top. The chip index fell 7% around it. That is not a company story. Somebody moved the price of money, and the price of money is now setting the price of shares. Start with the week itself. Every major index fell, and not one of them set a record. The S&P 500 finished Friday at 7,674, down 1.4% on the week. The Nasdaq lost 2.1. The small companies lost 1.6. Ordinarily, when everything falls together, you go looking for the news that did it. A war. A bad inflation print. A bank in trouble. Last week there was no such thing. The inflation figures were the week before. The Fed did not meet. Earnings, on the whole, were fine. When the standard explanations do not fit, it usually means the thing that moved is not in the news at all. It is in the plumbing. Here is the tell. On Wednesday the 19th, Analog Devices reported. You may not know the name. It makes the chips that turn heat and pressure and voltage into numbers, and it sits in the Philadelphia Semiconductor Index, the benchmark for the whole sector. Revenue, $4.022 billion, up 40% on the year before. Operating margin, on the reported basis, 40.1%. On the adjusted basis, 50%. Adjusted earnings of $3.45 a share. Records. And then it guided higher again. It was the only member of that chip index to report all week. The index fell about 7% across Tuesday and Wednesday. Nvidia lost about 4.5% on the week. So the one chip company that spoke posted the best numbers in its history, and the chip complex sold off around it. There was no chip news. There was no chip news because it was never about chips. So what moves a chip stock, if not chip earnings? A number almost nobody quotes and everybody pays. The real interest rate. Not the rate you see on the news. The rate after inflation. What money actually costs to rent. Here is why it matters more to chips than to almost anything else. When you buy a share, you are buying a claim on profits that mostly have not happened yet. For a supermarket, most of that money arrives soon. For a company building for data centers that do not exist yet, most of it arrives in the 2030s. To work out what $1 in 2035 is worth today, you divide it down by the real rate. A small move in that rate barely touches a profit due next year. It takes a serious bite out of a profit due in 10. Traders call this duration. It is the same idea as a long bond applied to a share. So when the real rate moves, the most future-facing companies move first and hardest. That is chips. And last week, the real rate did something it has not done this century. On Thursday the 20th, the United States Treasury sold $8 billion of 30-year inflation-protected bonds. They are called TIPS. The payout rises with inflation, so the yield is the pure real return. It is the closest thing that exists to the true price of long money. That auction cleared at a real yield of 2.973%. Say that plainly. The United States government has just agreed to pay, on top of inflation, every year for 30 years, almost 3%. The last time 30-year money cost that much in real terms was October 2001. The same auction in February this year cleared at 2.473. So the real cost of 30-year money in America rose 0.5 percentage point in 6 months. Nobody reported it. It is one line on a Treasury press release with a serial number next to it. And it repriced every long-dated asset on the planet that afternoon, including a chip company that had just grown 40%. Now the part that turns it from a statistic into a story. It printed at 2.973 and not above 3 because of something that happened the day before. On Wednesday, the Treasury Secretary, Scott Bessent, announced the government would double the size of its bond buybacks. That is, the Treasury going into the open market and buying back its own older debt. That announcement pulled yields down by roughly 9 basis points going into the auction, 0.09%. Without it, America would have sold 30-year inflation-protected debt at a real yield above 3%. That is a headline nobody could have ignored. Here is our reading, and it is a reading, not a fact. A 3 in front of that number was worth intervening to avoid, because the pressure is not hidden. The ordinary 30-year yield touched 5.337% on Tuesday, the highest since 2007, and the national debt went through $40 trillion this month. The bond market is no longer the background. It is the event. Stay with me, because in a couple of minutes I will give you the 2 minutes on Friday that matter more than nvidia's entire report. One more piece first, and it is the piece most people have backwards. If you are waiting for the Federal Reserve to take the pressure off, read what the Fed actually wrote. The minutes of the July meeting came out on Wednesday. The committee held at 3.5 to 3.75%. The vote was 9 to 3. All 3 people who dissented wanted to raise, not cut, raise. Several others said increases would probably become necessary if inflation does not come down. Headline inflation ran 3.4% in July. Producer prices ran 4.7%. By the middle of last week, the market had the September meeting at roughly 70% a hold, 30% a hike, and about 1% a cut. So if you have been told the market is waiting on a rate cut, that is not what is priced anywhere. And it is not only chips. Look at what happened to the shops. Walmart reported on Thursday. Sales at its American stores, comparing like for like, rose 2.6%, and the company raised its forecast for the year. The shares fell 9.3%, worst day since 2022. Underneath it, the split was brutal. Ross Stores, which sells other people's stock at a discount, grew 10%. Advance Auto Parts went backwards and lost a fifth of its value in a single day. And a warning about last week's earnings beats. Several of them were not trading at all. Target's reported figure included $1.65 a share of tariff refunds. Take that out and Target earned $2.46 against $2.33 expected. Still a beat, a far smaller one. So here is the week in front of you. Wednesday is the densest day of the quarter. At 8:30 New York time, 3 things land at once. The PCE inflation figures, which is the measure the Fed actually targets, the second reading of second quarter growth, and durable goods. Later that day, the Treasury sells $70 billion of 5-year notes, and at 5 in the afternoon, nvidia reports. Everybody is watching Wednesday. Watch Friday. At 10 a.m. on Friday, the 28th, 2 things happen in the same minute. The first is Kevin Warsh giving his first Jackson Hole keynote as chairman of the Federal Reserve. He took the job in May, and markets have decided he is soft on inflation. In July, he said, "There is no soft inflation target. There is only a target, and it is 2%. The second is not a speech at all. In the same minute, the Bureau of Labor Statistics publishes its preliminary benchmark revision, the once-a-year reconciliation of the jobs survey against actual tax records. Last year, that revision took 911,000 jobs off the books. The year before, 818,000. If it lands large and negative again, then in the exact minute the new chairman is speaking about inflation, the labor market he is describing will have been rewritten underneath him. Which brings this back to where we started. For 2 years, the question about a share was what the company would earn. Last week, the answer stopped, depending on that. Analog devices grew 40% and fell. Walmart raised guidance and fell 9%. What those two have in common is not in their accounts. It is in an $8 billion auction that cleared at a real yield America has not paid since 2001. That is our position, and it is a position. Earnings are no longer the variable. The discount rate is. 4 things to carry into the week. 1. The real cost of 30-year money is at a 25-year high, and it only stayed under 3% because the Treasury stepped in. 2. Long-dated shares, which means chips, move on that before they move on their own results. 3. 3 Fed officials voted to raise in July. Not one voted to cut. 4. Wednesday is loud. Friday at 10 is the one that can reset all of it. And nothing here is advice. One ask, and it is the only one. This is a weekly video. It goes out at the start of every week, before the week opens, and it reads the documents so that you do not have to. If that is worth having, subscribe, because the next one lands in 2 days. On Thursday, we take Wednesday night's nvidia filing and go straight to the one line we told you to look at. The line where the company has to spend its own money to be wrong. Almost nobody will open it. We will. See you Thursday.